guest joining us now, Neel Kashkari, Minneapolis Fed president. Extraordinary things happening in the last month or so. Neel, we keep using the phrase necessary but not sufficient. But necessary, that's the first step that you got to take care of. And what the Fed has orchestrated so far, you would feel that it's appropriate and necessary for where we are.
Absolutely, and good morning. Thanks for having me on. You know, our first job at the Fed is to make sure that the financial plumbing is working, that the Treasury market has liquidity and is functioning appropriately, that the mortgage market, the agency MBS market is also functioning. Those are core functions and jobs of a central bank, and we're going to use our tools aggressively, and we are using our tools aggressively to make sure that those markets are functioning, because most other financial markets in the U.S. at least are priced off of those markets. So making sure those foundations are acting in an orderly manner is a core part of our job, and we're doing the appropriate steps.
And the pushing on a string analogy, and you've had to deal with criticism like that, Neel, that we've got nothing left in the tank and we've got no dry powder, and what are we cutting now for when we'll have nothing when we actually need to do it? You know, after the 100 basis point move, the market had one of the biggest drops in history, but that's not what the Fed necessarily can control. They need to do, their job is to, as you just described it, is to keep everything running properly. Whatever the market does, they can't be looking back and saying, oh my God, maybe we spooked the markets and shouldn't have done that. They need to take care of what they can control. Would you agree with that?
Yeah, that's right. I mean, and you and your guests over the last several weeks have noted, I mean, first and foremost, this is a healthcare crisis, and the first responders are going to be the healthcare experts, the doctors, and the health policy experts. The second responders are all of us, just you're all quarantining yourself at home. We're working from home at the Minneapolis Fed. That's an important part of the response for all of the American people to take. The third round of defense, of course, are the fiscal actors, Congress and the White House. And then the fourth round are the central bankers. So we are not at the front line of this, but we do have a job to do, and we are using our tools aggressively to try to make sure that the financial system is ultimately working. And I think the actions that we took on Sunday were right. And by the way, the notion that we shouldn't have cut 100 basis points because we got to save our powder is just flat wrong. A lot of commentators say it. It's completely wrong. The right analogy is you're driving down the highway and you're worried that there might be a hill coming up. Do you accelerate now or do you wait to accelerate later? If you accelerate early, that doesn't mean you've spent your powder and you can't then get over the hill. So the notion that if we should save our cuts for later, it's a colorful metaphor, but it's just flat out wrong.
Hey, Neel, you helped write the original Break the Glass plan and the TARP plan that ultimately came after it back in 2008. And I wanted to speak to you about the fiscal side of this. As Washington and so many companies are going, or will likely be going hand in hand. We're already seeing the airlines do it. I've been talking about this idea of a national bridge loan for companies, if you will, that would be offered by the country, something, by the way, that could cost trillions of dollars ultimately. How would you approach it if you were in Treasury right now?
Well, I think, you know, the government knows how to deal with airlines and autos and a handful of very large companies. And whether those are loan guarantees or some other type of support, I think the policymakers know how to do that. The really hard challenge that I'm thinking of is what to do with the thousands, tens of thousands of small businesses across the country, the restaurants, the bars, the health clubs that are going to be shut for weeks or maybe longer than that. How does one structure a program to give them assistance? You know, if your restaurant is shut for literally months, I don't know what a loan is going to do for you, because how are you ever going to pay it back?
But Neel,
so it would likely need to be.
I'll tell you how I'm thinking about it. I'm thinking a 4-month bridge loan, interest-free, something on the order of 2 to 5 years to pay back. I think that if you came out big like that, and you run it through the banks, you have the banks maybe take only a 5% tail of the thing, so that at least they have some risk in terms of how they're offering these things. There will be fraud, there'll be abuse, all sorts of things. But I think it would create, if you're trying to create some kind of confidence and stability in the system to return to some semblance of normal, I think people would say, okay, we can do this. This will work.
Okay, Andrew, I agree with the spirit of what you're saying. The right answer, one of the mistakes we made in 2008 is we were always slow and we're always too timid because we didn't know how bad the crisis was going to be. We didn't want to overreact. As you've said and others, the right answer is, in fact, to overreact, to try to avoid the worst economic outcomes. And so something like you described in concept sounds right, erring on the side of doing too much. Don't worry about the wrong people getting it. Just try to do what we can to support the economy. That sounds like the right approach.
Well, but the other flip side is the politics of it and the political morass that comes after you've lived through it and know it so well. You're already hearing it with the airlines right now, which is to say that people are saying, look, the airlines bought back all the stock over all of these years. Consumers don't feel they're being treated right. If taxpayers are going to be offering them money, it's going to come with lots of strings attached.
Yes, I understand. And, look, the airlines seem to, like, every 10 or 20 years, something happens where they need some type of support. And I think it's appropriate for the American people and policymakers to ask, what is the long-term answer here so that we aren't back in the situation all the time? But again, I think that that's an easier one to solve. The harder one in my mind are the small businesses who did not take unnecessary risks, for whom this is not a regular occurrence, the restaurant owners, et cetera. That, for me, is where I would be focusing my attention on how to get them assistance.
Do you think there's any private market for this kind of assistance right now? I mean, by the way, for some of the big companies especially, I'm thinking of the airlines. Do you think there's a private market? Do you think somebody could offer them a loan right now, some kind of bridge loan at a interest rate that, doesn't bankrupt the companies themselves?
Well, it's very hard to see because the range of economic scenarios going forward, are we going to be following a path of Japan and South Korea, which is maybe a mild recession, or are we going to be following a path of Italy where we have to shut down the U.S. economy for an indefinite period of time? That huge range of uncertainty makes it impossible. It makes our jobs at the Fed very difficult, but it also makes it almost impossible for financial markets to price risk.
What's the estimate inside the Fed right now, meaning timeline inside the Fed?
I can only speak for myself. My baseline scenario is that we will have a recession this year. I'm hoping it is a 2001 type recession, a mild recession such as after 9/11. But if the worst case scenario happens and the virus spreads and we have to effectively lock down the U.S. economy, then we're looking at more like an Italy scenario where it could be more like 2008. That's why policymakers across the spectrum should be erring on the side of being aggressive so that we're in the mild scenario, not in the severe downturn.
But that scenario accounts for for how many months of activity that are slowed down? Meaning right now, where everybody's working from home, how long does that go on for in your scenario?
In the better case scenario, it's a few weeks, a month, something like that, and schools can reopen and people can start to go back to giving. It's really about giving the healthcare workers and the healthcare system time to catch up. The one possible good news is when summer comes, like the flu, it's not the flu, but if like the flu, the virus itself tends to tamp down, that would give the healthcare workers and the healthcare experts time to catch up to prepare for the fall. That would be the rosy scenario, but that's highly uncertain right now if that's in fact going to happen.
So, Neel, what else you got? What else you got in the tank?
Well,
I hear we got plenty of tools. We got plenty of tools left. Like what?
Well, just like in 2008, I mean, the Federal Reserve's authority, especially the emergency authorities, the 13.3 authorities, are very powerful if the Fed chairman, and I think in consultation with the Treasury Secretary, chooses to use them. And I think, nothing is completely off the table. We need to see what is necessary to keep the economy moving. And again, we're going to do our part. But I can't tell you right now exactly what is coming in the future.
You can go below zero?
As the Fed chairman said, I don't think there's much interest in going below zero. None of us want to say no, never. You could imagine a scenario where if Treasury yields across the curve continue to fall, imagine hypothetically, I'm not forecasting this, hypothetically, if the 10-year Treasury were at zero, just due to market forces, might we want to have a positively sloping yield curve? I could make that argument. That might be a reason to go negative on the front end, but that's not something any of us are planning for or expect to happen.
I think Becky's got a question.
But you don't
Neel,
think,
can I just ask? You mentioned the 13.3.
Yes.
You mentioned the 13.3 powers that the Treasury would be granting to the Treasury would have to sign off and say and do these things. Steve Leisman was just talking about how maybe the commercial paper markets would be a good place for that sort of action. You got any comments on that?
Well, I think we're all watching the commercial paper markets closely. We see the fact that there are strains there. I can't comment beyond that. Obviously, in 2008, the Fed did take action in the commercial paper market. So I think that that's something that we would look at. Not to mention a range. In my view, I think we should be looking at a range of markets to make sure that there's basic market functioning. And it's not the Fed's job to bail out airlines. That would not be something that I would certainly be advocating, and I don't think my colleagues would either. That's the job of Congress and the White House and the Treasury. But basic market functioning is a core responsibility of central banks. And I think we are going to take appropriate action to make sure the financial markets are functioning.
But Neel, you don't have the fear that not getting back to what people thought was a normal, non-emergency rate a couple of years ago to go back to higher yields when we missed our opportunity. You don't think we're seeing that scenario that so many people were worried about, that we stayed too low for too long, so the next time we have a real serious crisis, which this certainly is, that we're not going to be in a position, and we actually we're watching the Fed basically unable to come in and save things now and pushing on a string. You don't think that we're watching that play out?
I don't. I think the fundamental concept here is, what is the neutral interest rate that neither stimulates the economy nor restrains it? We don't set the neutral rate. The neutral rate is set by broader macroeconomic forces such as demographics, technology. The balance of savings and investment ultimately is what sets where neutral is. The neutral rate in advanced economies around the world has gradually been declining for 30 years, and we set interest rates around that neutral rate, but we don't control the neutral rate. And so many folks have said, boy, I wish interest rates had been higher for the last several years. Well, I would say to them, I wish the neutral rate had been higher. I wish there was more demand for investment capital, which would push that neutral rate up, and then we would respond to that. And so I understand the concept. People want to go back to the old days when interest rates were 5%, but that's going to depend on broader macroeconomic forces. Central bankers can't control that. And if we had, by the way, Joe, if we had just said, no, we're going to raise rates anyway, then we would have likely been putting the economy into recession, because we would have been running monetary policy much higher than the economic fundamentals would require.
Yeah, people think there was a window, not recently when we had to come down after December of 2000, whatever it was, when we were worried, but the 2 or 3 years prior to that, when we had such low rates and a pretty good economy. We'll see, Neel, I guess, but we appreciate. Go ahead. Yeah.
No, I was just going to say, as you know, that I was one of the few people arguing against those rate increases, just because I didn't see any evidence that the labor market was overheating. And I think that that's true. The labor markets continued to exceed expectations.